Well, good morning, everybody. It's 11 a.m. Welcome to the first of our programs for 2024. A belated Happy New Year to you. It's great to be back with you. We've got a hell of a program or lineup this year, so be on the lookout for it. And we look forward to sharing what we know will be a very exciting and turbulent year that lies ahead, certainly for the real estate market or the real estate industry. Want to thank our very good friends at HSBC Bank who host and sponsor us for this program, Rhonda Munoz and Jeff Needham. And a couple of quick housekeeping items. We've muted all of your sound and videos. Occasionally, one of you is able to get through the system. If you see yourself on screen, mute yourself so you're not seen on screen. Jose and I will be the only ones who should be here. There is a chat button down the bottom. If you've got a question of Jose, put it through the chat button and I'll keep an eye on it and I'll be able to include it into our conversation. This program is being recorded, as we do with all of our programs. If you're called away at some point throughout the program, you can come back in. And you'll be getting, we have a new email that'll come out to you called the Lux Stream. Will come out tomorrow or over the weekend, and it'll have the recording link in there, the Zoom recording link. So always check your spam folders because a lot of our communications go in there. And again, today is a 30-minute program, so we're going to be moving very, very quickly. So why the program today? Well, the nation is in political disarray. The Fed continues to equivocate in terms of interest rate cuts, et cetera, as it tries to ease inflation. We've got global conflicts. We've got saber-rattling. We've got a nation that's not in a happy mood right now. And the Bay Area is confronting its own unique confluence of economic, environmental, and social challenges. We've got the tech industry layoffs. We've got the vacant downtown San Francisco. So, and we had a sort of a strange 2023 in the real estate industry as well. So 2024 is certainly not going to be a ride for the timid. But as Hunter S. Thompson said, buy the ticket, take the ride. So that's what we're going to do. We're fortunate to have back our very good friend, Jose Rasco. I call him the Dean of Economic Prognostication in the United States, but he's the Managing Director and Head of Investment Strategy at HSBC Private Bank of the Americas. He's been with us now for a fourth year in a row, and he takes the arcane from the economists and makes it simple for the lay people like us to understand. Jose, welcome. Great to have you back, my friend.
Thank you. Good to see you as always.
I'm going to go 30 minutes. We're going to move quickly here. I'm going to hit you with a baker's dozen. I'm looking for some quick headlines here and some feelings on each of these. Let's start with consumer confidence. How is it?
Improving slightly. Remember, inflation has fallen faster than wages. That means real disposable incomes are up for the last 6-8 months. That's positive for consumers. They're feeling better, and the markets are up as well.
Recession, alive or dead, or maybe?
On resuscitation, it's almost in a coma. I mean, I would put the odds at 10 to 20%. It's not dead. We have a lot of signs out there that it could happen, but we have cyclical signs. We have secular long-term themes that are pushing the economy forward. Real tailwinds.
So if you were to call it today, you'd say yes or no?
No recession. Slowdown,
Okay.
but no recession. And there is a distinct possibility the economy actually improves from the 2.5% last year. We've got it slowing to about 1.5 from 2.5 last year. But it's a chance that it could actually improve.
Quickly, if there is a slowdown, how will we know that? What will we be feeling?
You'll see it first in the jobs data. You'll see it in the weekly claims. I'm sure you guys don't follow it, but Thursday mornings, 8:30 Eastern, claims come out. People, when they get fired, file for unemployment claims. And there's been a lot of firing going on, and people aren't filing for claims because there are plenty of empty jobs to be had. So if those numbers start to tick up, the unemployment rate will tick up, wages will slow, demand will, that's the first sign of a weaker economy. We also have the yield curve that's been inverted for quite a while. And sometimes you get head fakes from these things, but definitely the claims number is the one to watch, the most obvious one to watch.
Reduced inflation. We're at what right now? The latest was what, 2.9? Where are we on inflation for 24?
Well, if you look at the last 3 months, the CPI is going at 1.5%. If you look at the last 6 months, that's 3 months. If you look at the last 6 months, it's growing at 1.9. So 1.5, 1.9, both below the 2%. Remember, the Fed's target is symmetric. That means they want it to be above and below that 2% number, not just below. And right now, last 3 and 6 months, we're below. So they want to get, and they just announced on the press release that they want to have clear signs that we're getting to 2%. We have them. They just want to make sure we get through the spring. Energy and food prices could rise in the spring. They want to make sure we get past that before they talk about easing. That's March or April.
Okay. And interest rates, where are you putting interest rates if you were to take the center cut for 24, and particularly in terms of mortgage interest rates?
Well, I think they've come down a fair amount, but I think they're going to come down more. If you look at what happens historically when the Fed pauses, that happened in July. Next 12 months, you have an inverted yield curve. The short end comes crashing down, and the long end comes down a little. And that's where you get that positive slope to the curve. That's called a bull steepener. So I think we're going to see that. We're already seeing signs of it. The yield curve will be positive second quarter, second half of the year, somewhere in there. And more importantly, you will see mortgage rates continue to decline as the short end comes down, the long end comes down, mortgage rates will go down further for sure. Yeah.
By September 1, 2024, where would you put mortgage interest rates?
Well, there are 20 different indicators of rates, right? I would say down from here, another 50, 100 basis points could be the case. Yeah.
Okay. Stock market, 38,000 plus. Good for the all the 401k plans. Where are we on stock market for the balance of the year?
Look, fourth quarter earnings last year have been disappointing so far. We revised them from 8 to 0, and they're coming in at -1.5. So definitely disappointing. But if you look at the expectations, last year is going to look like 0 in terms of corporate earnings growth. This year, the forecast is 10 to 12%. Next year, it's 12% to 12.5%. So corporate earnings look good. Valuations are going to come in. We have in March, we have the government budget battles and do we close the government? Whole bunch of issues between now and March. I think the market has risen dramatically from October. And I think we're going to see a market that recalibrates earnings and inflation and the Fed. So that means a leg down for the market, for the equity market. Now, once the Fed announces March or April that they're going to start to ease, that can get fully priced in. That's very accretive to earnings. And I think you'll see the market go up. We're looking
39, 40,000.
But I'm looking at 10% plus from current levels. Yeah, that would be my guess. I mean, my bank is looking for a lot less than that, like 4 to 5.
Impact of re-election or elections. I want to start with Trump and then go to Biden. Trump gets elected. From an economic perspective?
Well, I mean, what it means is different priorities, right? So the global economic cycle is one thing, the domestic is another, and then we have those 4 secular themes: technology revolution, innovation, and especially in healthcare, nearshoring and onshoring, which Trump began before Biden, and then last but not least, the reindustrialization of the U.S. All 4 of those are very positive for growth and earnings and job creation. If Trump gets elected, look for the priorities to switch. Focus will be on energy and defense, and he will look to lock in or extend the 2017 tax cuts. So I think, but remember, during a presidential election year, last 12 elections, the U.S. markets have outperformed. The S&P has outperformed the MSCI by 3/4 of the time by 4%. That's a pretty decent number. So we're in a good place.
If he was to reimpose tariffs on China, what would be the macro effect of that?
Oh, well, they haven't gone anywhere, number one. Number two, Biden has made them worse. This year, we're going to see solar, the tariffs on solar are going to go up dramatically, especially on Chinese solar panels, which are the commentary from the government is that they're made, by inappropriate labor practices, right? So that is going to go up. That's going to make domestic production more likely and more profitable. And I think it's going to continue to foster that reindustrialization movement here.
If Biden gets reelected?
I think we see more of the same. We had the CHIPS Act, the Inflation Reduction Act. the Investment, Infrastructure, and Jobs Act. I think you'll see more of that, a bipartisan approach to try to modernize the grid and the economy, and put in, a lot of focus on alternative energy and social policy, and more so than with Trump. But I think, either way, it's going to be a heavy focus on investment for the future.
Speaking of investment, the three acts: the infrastructure bill, the CHIPS Act, the Inflation Reduction Act. Have we felt the impact of that yet, or
No,
is it to come?
still to
When will
come.
it come?
Remember,
When and how?
the Obama bonds, they're still out there, Alf. So, we have not even come close to feeling the full impact of that. That's just beginning. And if you look at construction of manufacturing facilities in this country, it's growing at 73%. That's not some emerging market that's in the US, my friend. Manufacturing plants are being built at a rate of 73% year over year. Booming.
So what does all that mean for us?
Oh, for real estate, it's great because you're going to have people moving. You're going to have companies building facilities all over the country, energy facilities, alternative energy. You're going to see all kinds of new facilities being built. Obviously, manufacturing and semiconductors, but ton of tech opportunities and innovation in healthcare. And you're going to see it built in a lot of states. I think the real focus is going to be in states where labor costs are lower, real estate prices are lower, and taxes are lower, clearly. And that's where we've seen a lot of the growth. And I think you're going to see more of an emphasis on that. So real estate in those counties and states should do really well.
Go back to China for a moment. You've got the real estate collapse, slowing GDP. The Belt and Road initiatives are starting to crash. You've got the U.S. sanctions on IP, etc. How will China affect us next 12 months, if at all?
Well, it affects us positively and negatively. Negatively, because there's no growth, means exports are not as strong. Positively, because there's no growth, or growth is slowing this year and next. And that means commodity prices stay muted. That means inflation can, in fact, continue to slow. So it's a good and bad effect. In addition, the resiliency of the US economy, as Jeremy Rifkin wrote a new book called The Resilient Economy, building that resilient economy, which, remember, began during COVID under the Trump administration, and Biden has continued it. So it's a bipartisan effort. That will remain in place, and it's going to continue to move Chinese manufacturing to other parts of the world: Vietnam, Sri Lanka, Philippines, and Mexico. And even though nearshoring can be more expensive, in the Mexico case, it's actually cheaper because it's closer. Labor rates are half of what they are in China.
Should we have any fear on supply chain challenges with the Gulf of Hormuz and the Houthis, etc.?
Yeah, huge, but I think huge mostly for Europe. Europe has two wars on its borders, and both those wars could affect energy and food prices. And more importantly, even if they don't affect prices, they will affect the speed at which things get to market, which means, yeah, you're going to have supply chain logistical issues, especially in the European economy.
Okay. Let's get into the worker, the sort of the worker revolt that's taking place right now. Higher minimum wage demands, flexible work schedules, etc. And then tied to that, of course, this whole debate going on now about remote work, 3 days a week versus 5 days a week, etc. What are you feeling there from an economist's point of view? Anything we should be looking at, or be aware of, or be concerned about?
Well, I mean, look, there's a double-edged sword, because there's no question there's a disparity in incomes. The upper 1% own a disproportionate share of the assets of our economy, and that's true around the world. But no, and so therefore, people who are lower on the income scale need to get that adjustment made. But remember, we've seen the minimum wage rise in 27, 28, 28, and now this year 22 states. That's the last 3 years. So the minimum wage has gone up a fair amount, and in many states it's gone up a ton, like California, Oregon, etc. And New York is trying to keep up. But I think so in certain states it's gone up a lot. What it means is lower wage workers will have more money. Again, as inflation has fallen faster than wages, real disposable income is up. That's good for the consumer. But remember, now the business owner now has to deal with that higher cost of doing business. So you will see consumers in general And the latest expectation from one of the Fed banks is that the surplus from COVID continues through the end of the year. So that means that you're going to see consumers continue to spend, but they're going to trend down as the economy slows, unemployment goes up. They're going to go from steak to hamburger. So expect that to continue, middle class and below, in terms of the income strata. That's something to keep an eye on for sure.
Back to real estate for a moment. I can't pick up the Chronicle without seeing another business closing, another restaurant. Restaurant's been in business for 80 years. It's closing. So we're still seeing bankruptcies and closings with small businesses. And then you've got, I saw a number yesterday that said 1.2 trillion, that's with a T, in unmanageable, operative word, unmanageable commercial real estate leases coming due by the end of next year.
Yep.
What does that mean for us?
Well, that's a very long answer, which I'll make quick. The cities, look, there's a bunch going on. There's crime, immigration, legal and otherwise. There are all kinds of issues around jobs and availability of jobs at the lower end of the scale, and a whole host of other social issues. So some large cities are really struggling, especially cities that have accepted a great deal of immigrants, right, and migrants and all that. So that's a social issue slash economic issue. It's going to create fiscal drag for the city and for the state government, no question about it. In terms of what else is going on, working from home, people want to go back to work, but they don't want to go back full time. Some people don't want to go back at all. And then some people have already moved and they're not coming back. So commercial real estate's under fire. Remember, though, after the great financial crisis, we learned. And so LTVs went down. So we actually lent less per mortgage or per facility than we did in the prior business cycle. So loans are smaller, the money at risk is less. And not only that, in 2021, when the Fed started, we saw the great refinancing, right? When rates went down. And so what happened is we saw a record of corporate bond issuance, an annual record in 5 months. So Alf, we had 1.4 trillion issued in 5 months. That's an annual record. What does that mean? Corporate CFOs decided if money is free, the Fed pushed Fed funds to zero. Let me borrow as much as I can, and I'll pay you back over 30 years, not 3. And they extended duration like about 12 to 15% of all lending, this historic level of lending, extended duration by more than 5 years. So for a lot of corporate clients, we're seeing that this great reckoning of corporate commercial real estate doesn't mean anything. They don't, the maturity wall hasn't hit them yet. It won't for another 3 to 4 years. That's number one. So the percentage of the market is small. The deals are smaller, more manageable workouts. But at the end of the day, there is a mark to market that's coming. Remember, 2024, Alf, it's 30 years that we celebrate the anniversary of the commercialization of the internet. 30 years. The Mall by My House is still trying to figure out what to do with the Lord and Taylor that closed 5 years ago, right? This commercial real estate is going to be with us for a while. We're going to repurpose it into residential, medical, homeless shelters and housing for veterans. But at the end of the day, it's going to take years and decades, not months. So this is a workout that's just beginning.
But to that point, you do believe that those malls will turn into residential properties at some point. Not all of them, but a significant percentage.
Yeah, to quote, paraphrase Mark Twain, the death of the American shopping mall has been greatly exaggerated. I know in Philadelphia, Detroit, they're putting old age facilities in malls. So, you can walk around at night, you can get your laps in while the mall is closed. They can walk around at night. And so there's a lot that's going to be done to repurpose these places, more experiential things and other opportunities. But healthcare is going to be a big part of it, no question.
Let's come into the Bay Area and San Francisco if we can. We're seeing a huge tech sector retrenchment. I saw a stat this week, 258,000 tech worldwide retrenchments in 2023, 76,000 of those in San Francisco Bay Area alone. Should we be alarmed by, first of all, why are we seeing these tech industry retrenchments taking place if it's a buyer's market for jobs?
Well, when you think you're going to go from 0 to 100, what do? You overhire, right? and you overhire and you overinvest and you get too much capital, and then you realize you wasted some capital, and there are a bunch of jobs that, frankly, you don't need. The beauty of 2024 and beyond is the tech revolution is actually beginning. And I used to write about the ABCs of digital media: access, broadband, and content. Today, it's the ABCDs. It's artificial intelligence, blockchain, convergence, which means putting two technologies together. One and one does not equal two. Alpha equals 5, because we have productivity, especially with AI, quantum computing, all the things that are here, extremely productivity enhancing. So you've got convergence is the C and diffusion is D. That's the key. Is how does you don't invest in my technology company. You're investing in how do restaurant chains, how do financial companies, educational facilities, manufacturing plants, how do all these places
Hi,
use
it's Lori Beekler calling about
technology?
1265
Hi,
0
Lori.
Could you give me a call back about the water? I'm not sure if you left it on. We
I
might have
don't know how
reserved.
we
I
got
can run
Laurie in
and go
here.
turn it off too. So give me a call. Thanks. Bye.
So
Let's
technology today,
go ahead.
Artificial intelligence, blockchain, convergence, and diffusion. Problem is they overhired. And what they're finding now is that demand is really strong, may not be as strong as they thought, as quickly as they thought. And some of those productivity enhancing technologies allow them to cut jobs too. So it's bad news. It's also good news. They're getting leaner and
So
meaner.
will we see more retrenchment in that sector?
Absolutely. Yep. We'll see more retrenchment in the whole economy. The story of labor, there's not enough labor and too many jobs, that's about to be turned on its head, Alf. You're going to see people looking for jobs in the next 3 to 5 years that they can't find.
All right.
Technology.
Downtowns, they're ghost towns, a lot of them. What's happening? Will that shift? Will that turn?
It's going to be hard. It's going to take a long time. Say's law of economics is a market clearing price for everything. But the problem is getting there, right? So you're going to see, if you look at distressed debt, I have a couple of friends that are experts in that. They do it very well. And what they're finding is that it's a combination of social, military, political, criminal. There's all kinds of issues in cities, right? Not to mention funding issues, jobs that can't be, so there's all kinds of issues. And it depends on where you are. Some of those cities are, in deep trouble, and they need to figure out what they're going to do to resuscitate the downtown part of the city. No question.
So Jose, if I'm a condominium developer in downtown Atlanta, and I've got the 3-day a week thing going on, I've got the downtowns becoming a chasm, what do I do as a developer, and what do I do as a realtor trying to sell those properties?
As a developer, you need to switch and do mixed use to make sure you can get people in, make the building as modern and as cutting edge and as interesting as you can. Real estate, what they're finding is double-edged sword. So some loans are coming due. It's like 20% of the outstanding. So it's not a cataclysmic event yet, and it's going to take time for it to get there. We can work through this, but more importantly, ton of foreign money coming in for this house. But if you're a building owner and you're trying to stay afloat, you have a situation where people don't want to come back to the office, or they want to come back less time. And then what we're finding is slower economic demand, slower economy. And then you have prices going down, right? That mark to market, Say's law. As a result, if you're coming into the building and you're getting it at $30 a square foot, I'm going to go back to the landlord and say, hey, I'll take another floor, but I'm getting that price. I'm not doing 45, I'm getting 30. So they're getting hit by loans that are coming due, weakening demand, and lower price points. So it's a double whammy, that is supply and demand. It's going to be tough. It's going to be tough. And certain cities are going to be much tougher than others. And that's where the foreign capital comes in. They're looking to step into those opportunities.
All right, we've got about 5 minutes left here, Jose.
Yep.
Quickly, overseas investors, stay with residential real estate if you can. That market disappeared for a while. Is it starting to come back?
It's back. People looking to come in, EB-5s, all kinds of programs, bringing money. Their kids want to study here. They want to start businesses here. They see the tech revolution and everything that's happening. They want to be part of it from other countries. The money's coming. Don't get me wrong. It's not going to be what it was, 10 years ago, where you had mass, but the inflows are picking up for sure. Look around the world. Tell me where else you want to put it.
Good point. Other key markets. Where are you? What are you hearing? I mean, I understand real estate's not your specialty, but are you hearing about other markets where it's becoming robust? I mean, Miami
Yeah.
is booming. Where else is it booming?
A lot of those second tier cities, and unfortunately, not, you know, and this can sound political. It's not. I mean, you know me better than that, guys. Those tax-free states, they're doing very well. Look at the sports leagues. A lot of the teams that are really good now are in tax-free states, because if you in California offer me 30 million a year, but you know a team in Texas offers me 32, I'm making a lot more in Texas because I'm saving on that state tax, right? So the leagues are going to have to deal with that. We have to deal with that as a society, because a lot of companies are moving as well as people, and that's going to continue to cause this migration. So those states where investment is flowing and taxes are lower,
Florida,
those are going to,
Texas.
Florida, Texas, Colorado, you know them. Those will
Okay.
do well.
Let's go to the wealthy quickly. The wealthy, right? They've got the wealthy. Where are they spending their money? Are they tightening up? Are the sphincters tightening, or are they spending well?
Well, I'm not a proctologist, but I can tell you, from what we're seeing, they're being a little more cautious. The money they have invested, they're keeping it. They've learned. They're switching from equities to fixed income because rates are high, and they want to lock them in. That's good. But they also see the long-term trends here in the U.S., and that is something they want to be a part of. Now, on the real estate side, a little more circumspect because they know there's a mark to market in certain markets, so they have to deal with that. All right. But bottom line is, and you have to look. CBDC is coming, my friend. We've talked about it a lot. Digital markets, blockchain, foreign investor influence is going to be here in a massive way, and so look for that to play out in our real estate markets.
I know you don't get into the granular side of crypto, but we had a realtor from Miami on a round table last month, and she's doing a ton of work with crypto, buy sell. Any feelings on this?
Huge. Not crypto, blockchain. Blockchain's what you want to look at.
Sorry.
You can no, it's okay. You can use crypto, you can use tokens, you can use NFTs. You want to digitize and fractionalize buildings. And if you want, I can come back. I can get you an expert of mine out of Miami. Her name is Taylor Perino, brilliant woman she was the first NFT salesperson in the US. She sold a building using NFTs 2-3 years ago. Still doing it. And I think that is going to be a major, major impetus in helping clear out some of this commercial real estate. You're going to have to create interesting blockchain related income producing funds. And I think you'll see money flow to it, but it's a huge part of it. Yeah.
Final question, Jose. I'm a realtor. I want you to put the realtor's hat on right now. It's the end of the month. February starts the spring cycle. We're getting buoyed up, ready to sell.
Yeah.
What are the canaries in the mine shaft that we should be looking at for the next 2 to 3 months? What should we be sensitive to?
Yeah, so weekly claims, if they go up, we've got a demand problem, right? Because you'll see the unemployment rate go up. Remember, typical recession, it goes up 3 to 5%. We're looking for 0.5% in this slowdown. So if it goes up more than that, we have a problem. Inflation, food and energy prices, housing prices could start to go up because demand is so darn strong. If that happens, could keep the Fed on hold longer than we think. Obviously, some sort of unknown, like a terrorist event, but we can't forecast that. So just keep it in the back of your mind. But those are the biggies, right? So inflation, what shocks could we see from food and energy and the wars, supply chain, and then the other one is interest rates. But I still think the Fed moves more. Remember, the Fed's going to move. I think the bank thinks starting in June, 75 basis points this year and next, 150 total. I still think there's a risk they move quicker and more aggressively. A third of federal debt has to be repapered this year. They don't want to do that at 5.5%. But remember, Alf, the 90s were boom times. What was the average Fed funds rate in the 90s? 5.5%. If you have stability of inflation and interest rates, markets adjust, and so do business people. So we think we're in for some good years here in the US, stability, growth in earnings, the whole 9 yards. The tech revolution is monstrous. And we provide a safe haven for a lot of people with really good returns. So look for that foreign capital.
So if I'm a realtor, just hang in. It's going to be okay. I just have to work for it.
You need more supply, right? You need existing home sales are cratering because nobody's selling. So you need more supply. You need more homes built. And that's a big part of what we need to see this year. More building and more new home sales. And I think you'll see that happen. And then the transference of commercial real estate to residential, it'll help on the margin, but it's expensive and hard to do.
But just to finish on that point, in San Francisco, let's say the minimum sort of price point is under 2 million. I've been holding out because I've got 3% or 4 or 5% money. As those rates come down, presumably that will open up. Yes.
Yes.
More
the
inventory
price-
on the will hit the market.
Remember, you know, if you're saying it's empty, there are a lot of cities going through that. And you're going to see, I mean, I remember the Bronx here in New York. It was empty for decades. And then prices went low enough. People went in, regentrified, cleaned up the crime and the nonsense. And then boom, it's a hot area to live in all of a sudden. And that's going to take time, but it's going to happen for sure. For sure.
Okay. Jose, as
By the way,
always, you are. Go ahead.
I never correct you, but I'm going to do it today, Alf. That was not
Please.
the last question. The last question is Niners are going to win. That's the last
Of
question.
course. It's not a question, it's a given. Jose, thank you very, very much. You
Thank you.
simplify everything in 30 minutes. We get more out of this than we get out of 5 years at the Wall Street Journal. To our audience, reminder, we'll be sending out a link. Look for a LuxeStream announcement that'll come out tomorrow over the weekend with a link to today's recording if you want to review what Jose said. A reminder that on the 15th of February, we've already sent out the first announcement. We've got a program called RIP, Rest in Peace. Will the real estate agent be next? It's an important program. It's going to be a killer program for you to watch. And that's on the 15th of February. And with that, Jose, thank you again for being with us.
Thank you.
We'll see you again, same time, same place next year. And with that, ladies and gentlemen, we are adjourned. Happy selling. Take care, y'all.
Thank you.